Welcome to our first asset allocation webinar of 2025. We hope everyone's having a great start to the new year. My name is Phil Huber, Head of Portfolio Solutions at Cliffwater, and in a moment you'll be hearing from Steve Nesbitt, our CEO and CIO. As always, our favorite part of these webinars is the Q&A portion, so feel free to submit questions throughout. Just please be aware that this is not a fund-specific webinar. It is intended for research purposes only, so we will not be able to answer any Cliffwater Fund-related questions online. With that said, Steve, please take it away.
Hey, thanks, Phil, and thanks to everyone for joining today. Before we begin, I'd like to say we have a number of RIA investors, as well as many employees in the affected areas of Los Angeles. If you're listening, thoughts go out to you. If we can do anything, please contact any one of us. Again, our thoughts go out to you today. If we can start on slide 2, I'll start by addressing the macroeconomy as a backdrop to financial markets. Then I'd like to move to asset class performance for the past year and our 10-year asset class forecast. For this webcast, we take a deeper dive into the assumptions surrounding global stocks, and particularly the outlook for U.S. stocks compared to non-U.S. stocks. For years now, we've been overweighting the U.S. relative to the rest of the world across asset classes. Okay? So later, I'd like to share some new research that we've done that guides that U.S. tilt. Next slide. In past quarters, I've described the government's tight monetary policy and loose fiscal policy. That has not changed, though both policy positions have moderated over the past few months. On slide 3, we show the most recent real interest rate, currently at 1.69%. That is still well above the 1.02% historic average, but down from over 2% last quarter. Basically, the Fed thinks it's getting close to hitting its inflation and growth targets, and we're starting to see some normalization on interest rates relative to inflation. The next slide. This graph comes from CBO. It shows in recent years, last decade or more, a growing deficit trajectory, but that is starting to moderate. And with the election, I'd expect further moderation and perhaps even some reversal. Next slide, please. It's hard to understand, but throw in a healthy consumer, and you get a U.S. economy that has been growing at about its historical 2+% historical average. I'd like to talk more about this just a little bit later. Next slide. My apologies, but I throw this slide in every quarter to again emphasize that U.S. capital formation, measured by U.S. stock performance, continues at a 10% annual clip. This almost over a complete century. If you adjust for price earnings expansion over this time period, that rate of return is about 8%. And I don't see any significant divergence in return from this trend line, as happened in the go-go 20s, 1960s, internet bubble of the 1990s. There are long periods, decade-long periods of where we sidestep growth. But overall, recovery always happens, and the trajectory seems to be almost a constant growth rate. Turning to next slide 7. On this slide, we report 2024 returns across asset classes and our long-term expected returns. 2024 was a risk-on market, pretty much opposite of what strategists predicted 1 year ago when they started to hype bonds. Instead, the stock market reported a near 25% return, on top of a 26% return in the rebound year of 2023. That bullishness extended to the credit and alternative markets. Even real estate, despite a small negative 2024 return, seems to be turning the corner. Of course, the typical flip side of a risk-on market is rising long-term interest rates that push bond returns downward. That also happened in 2024. Our expected returns in the second column of numbers are overall slightly higher from last quarter due to an increase in expected inflation from 2.35% seen in the last row, that is up from 2.2% last quarter. The higher for longer scenario seems to have greater traction today. Higher interest rates, higher inflation than that long-term 225 to 250 range. Also, higher long-term interest rates have lifted our return forecast specifically for fixed income asset classes. Finally, we've made an important change. Same slide, thank you. Finally, we've made an important change to how we forecast stock returns. Based upon past practice, we would otherwise be forecasting a 6.75% return for both U.S. and non-U.S. stocks. Instead, we are lifting both returns to 7.70% for U.S. stocks and 7.10% for non-U.S. stocks, based upon new research on buyback yields and earning growth rates in non-U.S. stock markets. Okay. The stock expected return lift is due to our new research into buyback yield. Corporate buybacks lift earnings per share by reducing the number of shares outstanding. In other words, earnings in the numerator stay the same, but the number of shares in the denominator declines, boosting earnings per share. You can also think of it as a second dividend. If you're confused, don't worry. There's more on this just a little bit later. Our research also points strongly to differences in U.S. versus non-U.S. growth rates that we can now quantify and incorporate into our expected return calculations. Again, more on this shortly, but first I'd like to turn to slide 8. Okay. We've taken our earlier graph from slide 6 and added the performance of EFA, or developed international markets, and emerging market stocks from their inception, which was 1960 in the case of EFA stocks and 1988 in the case of emerging market stocks. Again, that wasn't the inception of those markets, but that's when we first got good data, and CAP International had created indices that could track performance. I've attached those two performance lines, okay, again, EFA and emerging markets, to the US stock line at their inception point. I think you can see, and our takeaway is that non-US stocks significantly underperformed US stocks. Again, it's both EFA stocks and emerging market stocks, and it's significant. And as we have shown elsewhere, basically there is no diversification benefit from non-US stocks. Again, those low correlations of the 80s and 90s, they're gone now, and correlations are very high, close to 1, and really approach 1 when US stock market is off. Going to the next slide. Thanks. The likely reason for this poor performance is low to no GNP growth outside the US. Okay, so this is in this graph, we're showing GDP growth, real GDP growth, from just before the financial crisis to afterwards. you can see that post global financial crisis, U.S. GDP growth has averaged 2%. It's real growth rate, but the number is 1% or less, both for Europe and Asia. And if you've looked at the numbers really closely, it appears to be getting worse. In other words, the divergence is becoming even more significant. So this, I believe, really underpins the numbers I'll show you right now on slide 10. Thanks. So on slide 10, let me take a little bit of time here because this really summarizes a lot of the research we've done over the last couple months on trying to understand capital formation around the world. If you look at the top table, okay, I'm going to start with yield, okay, and I show yield for U.S., Europe. The UK is separate from Europe because it's basically has its own currency and moves to the beat of a different drummer, and Asia Pacific. So these are the major regional areas underpinning the MSCI ACRI index. I also show as kind of a reference point the Magnificent Seven because there's so much discussion about that group of stocks in recent years. So under column 1, I report the yield, okay? But it's not yield in the normal sense. I'd like you to focus your attention to the second table on the right-hand side of this slide, midway down the page, where I first report yield, which is the same, the columns headed 1 plus 2. That's the same yield as I report in column 1 up above, with the U.S. at 4.13%. So basically, we're defining yield now as having two components. Some of you are well aware of this configuration. But the first is what we typically know of as the dividend yield, payment of dividends divided by price. Okay, that's in column 1. Again, I'm focused on this table midway to the right in the graph in the slide. So if you look at the dividend yield, your takeaway is, gee, the U.S. has low cash flow in terms of distributing money to shareholders. They're 1.9%. UK is the highest at 4%. Europe is at 3%. Asia Pacific at just a little under 3%. US seems low, and the Magnificent Seven, Mag 7, is less than 1% at 74 basis points. And again, these numbers are average numbers over this 10-year period. We missed that all these numbers are based over a 10-year period, 2014 to 2023. So basically, higher dividend yields outside the U.S. But then in column 2, again, in that smaller table, I add back the buyback yield, okay? So this is money distributed to not all shareholders, but selected shareholders who sell their stock back to the company, okay? Still, it's an actual cash payment to shareholders, but not the entire group of shareholders, only those that elect to sell their shares, okay? You can think of the buyback as an extra dividend. In the past, we've kind of thought about it as a way to grow somewhat artificially earnings per share, buying back the individual shares. So at a per share calculation, the denominator is shrinking, other things being equal. You can look at it either way. But the buyback yield whether it contributes to earnings per share growth or contributes to cash outlay, is generally highest in the countries where dividend yield is the lowest. So if you look at the U.S. Over that 10-year period, the buyback yield has averaged 2.19%. It's lowest in Europe and the Asia Pacific, 60 basis points and 58 basis points, and also modest in the UK at 1.06%. So you take the dividend yield and the buyback yield, you get the total yield shown in that first column. And if you look at total yield, basically it's not, with the exception of maybe the UK, which would have the highest combination, it's not too different across regions. And if you look at the Mag 7, the Mag 7 is not too different either. But basically the Mag 7 is providing that cash payout primarily through buyback yield rather than dividend yield. So basically, my takeaway is, and going back to that top table, if I could, my takeaway is, if you look at yield, it's not too different across these major markets, and that includes the Mag 7. Second part of this table, growth. So basically, the return capital formation is a combination of yield and growth, or the return on investment. We've covered yield now. Let's talk about growth. And this is growth in net income. We've also looked at growth in EBITDA. It's really not materially different from earnings per share over this period. But basically, if you look at growth, and there are very significant differences. In the U.S., growth has averaged 6.68% over this period. Again, this is not earnings per share growth, but total earnings growth over this period. Okay, and far below the U.S. has been Europe at 2.66%. Asia Pacific has done nothing at 78 basis points. The UK is in the toilet. I mean, they've been, I think everybody's aware of their problems, but the compound annual basis minus 6%. So if you look at the middle column, subtotal, the I would call it return on investment from these markets, okay, total over 10% for the US. On the flip side, negative for the UK. Europe, okay, 6%, and Asia Pacific, a little bit less than okay at 4.28%. Now, over that roughly 10-year period, we've also seen changes in PE ratios. So if you're looking at actual investment returns, you have to add PE expansion or contraction. Those are shown on an annualized basis in column 3. And so if you're looking for total return on these regional markets, last column would be what to look at: 13% for the US, 5 and 5 for Europe and Asia Pacific, and negative for the UK. Okay, so I apologize for taking so much time on this, but I want you to understand kind of what our thinking is based on being able to dissect all this data. Now let me do a sidebar before I go to the headline here. If you look at the bottom right-hand table, it has one column, okay? And I look at these different markets, the US, Europe, UK, and Asia Pacific. And everybody's concerned about the Mag 7, what a large part of the index it represents. I show here that it represents 26% of the U.S. stock market. That was at the beginning of the year. I think it's over 30% now. But as of the beginning of this year, let's say, I apologize, beginning of 2024, it was 26%. But I was wondering, gee, how much concentration is there in these other markets? Well, it's pretty significant. Europe, the largest seven, represent 19% of their index. UK 40%, Asia Pacific 15%. So it's not at the concentration level of MAGs of the U.S. Stock market, but it's pretty significant. And if you go back 3 years, MAG 7 was was just breaking 20%. So concentration, from our point of view, is interesting, but it doesn't dominate the way we think about the global markets or market efficiency. So let's go to the headline graph here on the bottom left. So I hear a lot about hey, the non-U.S. stock markets are way undervalued. It's a real value opportunity. In past quarters, I've said, well, I kind of think it's a value trap. Okay. And the reason I thought it was a value trap was growth rates. There's such a significant and persistent difference in growth rates. My feeling was that explained differences in price earnings ratios. And so I did this graph. Now that I had this data, and by the way, this data comes from the underlying data comes from FactSet, but the commercial index providers, they don't really calculate this data. So we had to kind of do the hard work of scrubbing and compiling it ourselves. If you're interested in it, always glad to share. But basically, I plot price earnings ratio, okay, against that's current price earnings ratio against past return on equity. And again, return on equity is equivalent to that top table, that column 3, okay? Yield plus growth. Okay, not column 3. I'm sorry. I apologize. That middle column, 1 plus 2, yield plus growth. So I look at this and I say, gee, these regions pretty much plot on a straight line. The PE ratio is not fully, but close to fully explained by the return on equity. So I'm not in that camp where I'm particularly concerned about U.S. stock valuation, or that I'm particularly concerned about U.S. stocks, the relative value of U.S. stocks versus non-U.S. stocks. I'm not even in that camp of being particularly concerned about the MAG 7 valuations. It all seems consistent to me with past cash flows, both dividend or buyback, and growth in cash flow or earnings growth. So with all that said, given that conclusion, given the fact that global diversification doesn't work, it's not particularly helpful. There are other sources of diversification domestically. If you turn to the next slide, thank you. we basically would share with you kind of our model portfolio. And by the way, our model portfolio doesn't fit everybody. Maybe in a sense, it fits no one. Obviously, each investor is unique, and their preferences have to be incorporated in this. But basically, if you started, let's look at this first column, and this was a year ago, December 23. So if you went to our webcast from a year ago, you would have seen this model portfolio. So we've been consistently tilted towards U.S. stocks. So we had 30%, back then we had 30% and 10% in U.S. non-U.S. stocks. So basically, we were 75% of stocks, 75% were U.S. At that time, 60% within the equity index, 60% was U.S. So we had a 10% overweight in U.S. Okay, that seems to have worked out last year. Let's follow it across. So we didn't make any change in June. So now we're bumping our U.S. stock allocation to 35%, reducing non-U.S. stocks to 5%. So we got a total of 40 we remain 40% in stocks, but we've tilted more towards U.S. That is also an overweight. Right now, U.S. stocks represent about 66% of the index. So basically, we've got about a 20% overweight relative to equity for U.S. stocks. But because the U.S. is rising within that equity index, if we want to overweight, we have to increase our U.S. stock allocation relative to non-U.S. stocks. So we're doing that at the end of this year, at the end of 2024. Okay, that we'll see what happens, but based on our GDP growth rates, based on earnings growth rates, based on GDP growth rates, this seems to be the right direction, at least according to our models. On fixed income, remember a year ago, cash yields were high at 10. At mid-year, we shifted to a greater allocation to bonds, given that real interest rates had gone up. So we felt we were being compensated, and so we increased our allocation to 20%. That basically has been a wash in the second 6 months, but we're maintaining, given real interest rates are now, we continue to want to hold bonds rather than cash. But we're keeping our private debt and private equity allocations at a similar weighting relative to a year ago. I will say that our model portfolio for the year, using the benchmark shown on the right-hand side, and the 2024 returns shown in the far right for those different asset classes. Basically, this model portfolio produced 15.8% for 2024 versus an 11% for a 60/40 portfolio. Okay, again, just summarizing, we shifted 5% from cash to bonds. Okay, and shifted 5%. That was mid-year. Shifted 5% from non-U.S. to U.S. at the end of this year, giving us 88% of the model portfolio stocks versus 66% in the equity index. So we have about a 20% overweight, which is, I consider, pretty meaningful, and I think most people would. Our allocations to private assets in 2024, that would have returned 22.2%. Basically, We use interval funds as a benchmark for private debt and private equity. You could probably guess which interval funds we use. And then if we took a composite of the public assets in this model portfolio, that was 12.7%. So almost a 10% delta on the alternative side rather than public stocks. Okay.